Hey everybody, and welcome to chapter 8 or lesson 8 of Learning to Day Trade with Tony. Hope you're all doing well. Today we're going to go over trade management and your psychological game. Um, okay, which is probably 80%, if not more, of the skills required to be a profitable day trader. If I'm being completely honest, we've talked about in the past. One of the biggest obstacles for successful trading are your own emotions. It takes a long time to learn to control your emotions, especially when you're in the middle of a trade. And for me, it was a process that took, it took quite some time, took a long time. And it's something that even still to this day, um, I'll have days where I just find myself getting maybe a little bit more emotional than usual and more frustrated than usual. And I have to recognize that. And when I do, I have to just recognize it and take a step back. The most difficult thing for new traders is that they may recognize they're getting frustrated and emotional, but they don't take that step back. They just keep trading, and they get more and more and more aggressive, and that in itself can be really really devastating. Okay, so it's hard to become comfortable with experiencing losses. I mean, it's just as simple as that. If you think of a home builder, a carpenter who's building a house, and every 3 weeks someone comes along and knocks down half the house, and he has to rebuild it. You know that would, I mean, that would drive him crazy, right? As day traders, we have to get used to being knocked down and rebuilding accounts. There's no such thing as an equity curve that goes straight up. You stir step up. You go up, you go a little sideways, maybe down, up, down, up, down, up, sideways, down, and you just got to hope that your hot streaks, the periods when you're moving up are bigger than the periods when you're moving down. Ultimately, that's what we want. We want to be building our portfolios, and what we want is that we're making steady progress. But we have to understand that there will never be a portfolio manager that produces a straight equity curve, um, that doesn't have any pullback. So even the best traders in the world experience losses. So losing is simply part of trading, right? The professional traders and the folks that are really, really good at what they do, they simply get comfortable with experiencing that loss and not allowing it to manifest into this sort of a aggressive gambling revenge trading type of mentality that a lot of new traders will fall into. So successful traders have learned how to recover from getting knocked down without losing composure, right? Losing money is part of the job for us. And there are some people that are so averse to risk that even risking 20 bucks, $20 is too stressful. And this is a moment we've got to be honest with ourselves. Day trading is risky. Investing is risky. If you're not comfortable with risk and it's something that you just can't overcome, then that's okay. That's fine. You just have to acknowledge that. And that's part of your personality. But you've got to acknowledge that this might not be a good career fit if that is who you are, right? You have to learn to get comfortable with taking risk, experiencing the emotions of being down in a losing position, uh, and not letting it get you flustered, right? But as I've talked about, that ability to maintain composure, uh, it's a practice. It's kind of a meditation, if you will. It's a muscle, and the more you practice, um, on one hand, the better you get. But there are always going to be days where you're just having an off day. And this includes me, and I'm sure you know, I'm successful. I'm a successful trader now. I wasn't always a successful trader, but I've got a strategy, and I'm profitable now. You know, I'm sure it includes some of the tremendously successful traders that are out there. I'm sure they have days where they come into the office and they've got something going on in their personal life or whatever it is. They're not on the game, and they know they have to be able to check in with themselves, because when we're making decisions where a lot of money could be on the line, we really we really want to be we want to have a clear state of mind, right? You know, um, just yesterday, for example, I had a big loss yesterday, and I came in, and this is typically how it manifests yourself. So I came in yesterday. I had a good weekend. I had a small loss on Friday, but by and large, we were doing well for February, and I had a small loss on Friday. Had the weekend. My team was playing in the cup final on the Sunday, so I went out, met a few friends, watched the cup final, celebrated the win, and of course, the celebrations got maybe a little bit out of hand, and it just then what started off as a late afternoon session with the guys watching the football went into an early evening, went into a late night. And I got back early hours of the morning, a little bit worse for wear. Got up this in the morning yesterday, slightly hungover. Still in a euphoric state from being the cup champions and winning the cup, but perhaps my head wasn't right. So in hindsight, and hindsight is 2020 vision. In hindsight, perhaps it wasn't the best day for me to start trading when I'm already in that, maybe a hazy head type of mentality, and I ended up losing $28,000 yesterday. So it can happen to the best of us, and I'm sure it does happen to the best of us. Last year I traded tens of millions of dollars worth of stock over the course of the year, cumulatively. I'm talking. Okay, so I'm making lots of trades every day. I'm trading, thousands, sometimes hundreds of thousands of dollars worth of stock in a day, and I need to be able to be focused while I'm making those trades, right? For me, when I generate profits, I'm taking sometimes large positions. I'm executing trades and I'm taking a little bit of profit, a little bit of profit. 500 here, 1,000 there. It's just repeating that. But if I get into a frame of mind where something starts going wrong, um, if things start going against me, I get frustrated. I have a lot of, the towards the end of the last month, I had a lot of buying power in the account. I've just taken it out and did it on purpose. But I could be trading with a lot of buying power in the account. I've got a lot of leverage from the broker. So I have to be responsible with that. I have to be careful how I use that. So if I'm in a really bad mood, or whatever it is, I'm not in a clear state of mind, it's not a good time to be trading. But if I recognize that, um, I can take a step back. Okay. And this is something that new traders find really hard to do. It's really hard to recognize the point where you go from being in control, to not being in control, and being able to step out, step back, walk away, you know, get out of your home office, or wherever it is you're trading, go for a walk or something, switch off. Okay, that's the hardest thing, and I know that, because it was hard for me to just get up and walk away in the first instance. What I would usually end up doing is aggressively trading until I was just down so much I couldn't even. There was no way I could make it back in one day, and I would just feel defeated, and I'd give up. Of course, going back to the hindsight being 2020, I should have just walked away sooner, which is something that I still have to work on today. Okay, so when you take a few losses, the natural instinct is to try to recover those losses quickly. You know, say you lose 500 bucks right out of the gates. Human instinct, your natural instinct is to try to make that 500 bucks back on the next trade. That's just human nature. Uh, that's the way we're programmed. But that instinct is actually really dangerous because what we end up trying to do is force trades. And what you'll realize is that no matter how many millions of dollars you have, you can't force the market. Every time you try to force the market's going to kick you right back in your face. You know, if you're looking at a stock and it's down, um, and you just keep adding and adding and adding, thinking that you're gonna, uh, people are just are gonna see your shares, you're gonna see you buying, and they're gonna come in with you, and then they don't, and it drops, and you get destroyed. I mean, it's a quick lesson. We can't control the market, right? So if there's not a good setup, if we've lost money and there's not a good setup, we can't get super aggressive trying to make it back. The money that we've lost is lost. Okay, it's about stepping back and then push the reset button. Is probably a way of, that I would say push the reset button. Go back to trying to make proper trades with proper setups. Okay, we've talked a lot in the last few chapters about managing your risk. Okay, you know, if you have a month where you lose $10,000 or a year where you lose $40,000, $50,000, whatever it might be, you're not going to bounce back from that loss in a single trade. Certainly not in or even in one day. Okay, it's going to be over a period of time. So you can think of if you're trading in a way, kind of like the tides. Okay, you have a shift. So we have periods where trading is strong. We're putting in, consistently green days. We're on a nice upswing. We're on a hot streak, and then we fumble a little bit. Tide starts to change. We start having a little bit of a pullback, right? So we experience the pullback. We've just got to chill out, sit back, go easy, not fight it, right? Just go easy and let it happen. Wait for our good go-to setups to come back to us and then start easing into them. One of the biggest confidence boosters after you've had a red day, a really bad red day, or a streak of red days, is just to close the next day green, even if it's only $50. Okay, it's important. So going back to this last weekend, very recent event in my memory. Small red day on Friday going into the weekend. I wasn't too worried about that. If I'm being completely honest, it was 1,200 bucks. I think it was in the red I was on Friday, and I came in on Monday and I thought, okay, we've got over $100,000 in equity there. We've got $700,000 worth of almost $700,000 worth of buying power. I can afford to take some big size, and I took three trades on Monday, last day of the month. Three trades, and they all went against me. All substantial losses. $28,000 we lost on Monday, and I took to make matters worse. It happened live on stream as well, so we were live streaming that as well. So it was after the month that I just had with the small account challenge. It was humbling. It brought me back down to earth to take a big loss like that. after having so many green days in a row and some really big trades. It was a reality check. So came back in today, and the first thing I do is I start taking smaller sacks. I start being a bit more conservative in the trades that I'm taking. So I'm looking for those setups, the right setups. Okay, I'm looking for the good setups that we want to be. We've been talking about it over the last few lessons about only select the good setups. Only take the good trades. So that's what I would do it. So today I came in and I took some good trades and I got faked out a couple of times, but the setup was right. So I started the day, a little bit red, but then we got the good setups. So they came to us and we finished the day green. We had a losing trade and a winning trade. The winning trade was over $2,000. We finished the day green to the tune of just over $300. It's a green day. I'm happy with that because I'm green $300 today, whereas yesterday I was down $28,000. So that's a big swing. That's the way I look at that. That's a 28,000 over a 28,000, nearly $29,000 swing in my favor, and I've got to look at it in that positive light. So it doesn't matter how big or small your green day is. It's important. It's just to have a green day. Put a green day under your belt. That's a big confidence booster, and then you just do it the next day, right? And then you have two green days under your belt, and you're not trying to hit big winners. You're not taking big risk. It might only be 50 or $100 at a time, but you're putting in some green days. You're putting green days back into your portfolio, right? You're building that consistency, that momentum back up. You're getting the confidence back, right? And then you can start tapering back the risk, increasing your positions and your size, and then you start finding yourself back on the hot streak. You've got the confidence back. Okay. Then you make another push, and inevitably you'll come to another point where the tide shifts again, and guys, you slow down a bit. So it's just really important to recognize the emotions that you experience as you cycle through these hot streaks and cold streaks, and they do happen. But you've got to control yourself. You don't allow a cold streak to be worse than it has to be, right? When you realize that there aren't good setups, that there aren't good gappers, that the market's not trading in a way that works with our strategy, the best thing to do is just to sit tight and wait, right? Don't try to trade through the choppiness. You just sit tight and wait. So here's a good question, actually. This is a great question. When do you get aggressive, right? When is the best time to get aggressive? When do you naturally get aggressive? So I've found that I would naturally get really aggressive if I hit my daily goal. I made it say $1,000 and then lost it and went red on the day. So if I'm up $1,000 and then say lose 1,600, that puts me into a very aggressive emotional state of mind. I get very, very frustrated, and I immediately want to make it back. And because that's such a big swing in the daily profit loss, going from up 1,000 to down 600, I I even I did something really, really stupid, and I'm not perfect. I'm just human like the rest of you, and I'm not averse to taking a stupid trade from time to time. So either I've done something really, really stupid, or just got really bad slippage on a trade, or whatever it is. Something went wrong, but there's this instinct that you just lost $1,600, Tony, in like 2 minutes. So I'm going to make it back on the next trade, right? I would get very aggressive, and then I'd spend the rest of the day grasping at straws. And anything that would move, anything that was looking good, I would just jump in with that 5,000 shares. Think Yeah, look, all I need is 25 cents. If I make 20 cents, I'm going to be back up to green on the day. Yeah, 15 cents, that'll put me at break even. I'd just be really, really aggressive, trying to get myself out of the hole that I just dug. But more often than not, those days for me would end up much worse than, down 600, right? Because I w- I wasn't I wasn't making good decisions. Ultimately, I would start making really bad decisions. And what I realized is that for me, the best time to be aggressive is where I'm naturally trading at my best. So that, for me, normally, that is after the opening bell, 9:30 a.m. to 10 a.m. market time, or 2:30 p.m. in the afternoon where I'm sitting, to 3 p.m. Um, right as the market opens, that's when I trade my best. So why go light in the morning and then wait to get aggressive after I've made a mistake? I should do the opposite. I should be aggressive out of the gates during the time of the day that I have the best percentage of success, and then go light for the rest of the day. So I don't risk giving back the profit that I've made during, you know, that opening time. That time of day when where for me just went well. So I might I might make I might have been trading at 75% success in the morning, but I wasn't using bigger positions than usual. So I would just make 200 or $300 or whatever it does in the morning, and I would keep trading the same size and keep doing that through the day. And then I would lose midday. I would lose at lunch and lose a little in the afternoon. And I would slowly, just slowly, give back my day. And that became extremely frustrating. So, you know, another thing to consider is when you hit your daily goal, turn off your computer and walk away. Now, I make that suggestion. It's not a suggestion that I personally use every day. This Think of this as do as I say, not as I do. It's not something that I use in every day in my trading, and maybe I should. I've got to be honest, maybe I should. But I, I I have this feeling that when I'm having a really good day, potentially I can continue to be aggressive. Now I've got a cushion on the day. Start off with a cushion on the day. um, I can use that cushion to be a little bit more aggressive and sometimes generate some really big winning days. But if you're in the place where you're still trying to build consistency and you're still trying to build your confidence, then I do think it's important when you hit your daily goal uh, and you're green to just walk away. Okay? Book as many of those green days as you can because that's a big confidence booster. Now, you know the risk of trading all day. If you're trading all day long, trading past your daily goal, the risk is that you'll get into the habit of overtrading. Now, if I make $1,000 by 9:45, um, I've only worked for what, an hour. Okay, from when I sat up at the desk, the market's only been open for 15 minutes, but I've been maybe at my desk for an hour at that stage. If I'm streaming, it's a little bit longer, but that's more to cater to the stream than the market. But let's just say I've been working for an hour. The market's been open for 15 minutes. There's a part of me that feels like, do I really call it a day at 15 minutes into the market? Uh, you know, but is that, do I feel like I've done a day's work? Okay. as a trader, do I turn off my computer at 9:45 market time and then go back and watch Netflix for the rest of the day, or log into Sky Sports, or I'd feel lazy if I did that. I feel like I'm not working, so I stay in front of the computer, and then, like I said, I'd give back my daily goal, give back the profits I've already made in the first 15 minutes, and end up with nothing. And that's the way it is. So over trading is a problem because if you get into that frame of mind where you're just aggressively trading, and you're gonna churn commissions. You're gonna build up. You're just gonna have so many commissions that you're going to be churning shares. You're going to turn in commissions, and a lot of the wins are going to be really small, and it's going to be stressful as well. I mean, it's not. This is not a happy gig. It's not a job that's not without its stresses. Okay, and it's just not really worth the time. So it really is a good idea to at least cap your trades for the day. Uh, that's also a reminder. You know, uh, have I exceeded my 10 trade per day max or whatever it is? Because if you're taking too many trades each day, then you might be getting to that over trading type of mentality, where you're doing 50, 60 trades a day. And it's just hard. It's very hard to track your profitability when you trade that much. And typically, when you trade that much, you end up trading lots of different strategies, and it's just difficult to keep track of where you're doing well, and where you're not doing so well. So setting a max of how many trades you allow yourself to take each day is a good idea, just to prevent yourself from getting to that over trading type of mentality. Okay, so each trade should be carefully analyzed, and it should be analysed within one of your written trading strategies, and it should be part of your strategy as a trader. You don't want to just start stabbing at things because they're moving. In terms of what a good number of trades to take per day, I would say between 3 and 10 would be perfectly reasonable. And look, if you can make $500 to $1,000 a day on 3 trades, and you can do that consistently, meaning 3 to 4 days of the week, then I don't really see a reason to trade more than that. You might think, well, if I trade 6 to 12 times, then maybe I'd double my profit. Well, maybe you would, but it really depends on the strategy. For me, I can make $500 to 1,000 a day with 3 trades using my gap and go strategy. But I can't trade that. That's just usually one trade a day. I can't take a ton of trades at that time of day, right? So I'll take one and I'll focus on and take one first, complete that, and then focus on the next one. So even if I wanted to take more, I really couldn't. There's usually only one hot gapper each day. Um, you know, with bottom bounces, you're just taking what are being set up by the market. So there might be a day where there's a bunch of them, and there might be a day where there's only one. So you take what the market gives you, and some days it's only going to be 2 or 3 trades. Other days it's going to be maybe 10 or 15. More than 20 for me would be a ridiculously busy day. I would rarely trade more than 20 times in a day. So that gives you a little bit of an idea. If you're trading, 30, 40 times a day, I would say you're being pretty aggressive. You're probably being very aggressive. Okay. Now, you have to ask yourself, when is my best trading, right? And this is a course where having that data available because you've been tracking it in your Excel spreadsheet or Trader View or Trader Journal or one of those documented trading documental apps. This is where it comes in really handy to track it. Okay, knowing when you have your best time of the day. What's the best hour of the day for trading? For me, it's the morning. For you, it might be power hour from 3 to 4 p.m. market time, or it might be, I don't know, it could be from 10:30 to 11:30 in the morning. Maybe you're not good right out at the open, but you're good, say, mid morning. You've got to figure out your zone. Um, what time of day do you trade best? And when to be aggressive, when to go easy. You know, when you know what time of day you trade best, you also inevitably know what time of day you're trading at your worst. So if you're trading at your worst between 11:30 a.m. and 1 p.m., then you see something pop up on the radar. It's probably not a good time to go and swing for the fences. Um, take a note of when you're at your best. Okay, don't try and hit home runs when historically you're not at your best concentration levels. Over lunchtime or whatever it is, because you're not yourself when you're hungry. Have a Snickers kind of situation. Um, don't just go and hit for the fences just because you see it happen. Have that as part of your strategy. You have your trading times as part of your strategy. Okay. So if you're trying to trade when statistically at your worst, it's probably not a good idea. Just like someone that's into sports, knowing your stats is really important. So, we've run our stats on our own trading, and that it just takes a few minutes to track each trade in an Excel document, or import them into TraderView, or whatever it is, and you can have that data. You can review later in the week, or in the evenings, or in a month, or several months down the road. Now, I've said it before, discipline is practice. Discipline, in a lot of ways, is what separates good traders from bad traders. Um, I mean, we need to have risk management. We need to know how to choose the right stocks, choose the right patterns. Those are all elements of managing our risk. But ultimately, when it comes down to selling a trade that you're down on, it really just is a matter of discipline. Do you have the discipline to do what's hard and take the loss before it gets worse? Right? It's not fun to take $100 loss, but it's a lot better than taking $1,000 loss. And holding on to it, the longer you hold on to a losing position, the more likely that's going to happen. So building up your ability to be a disciplined trader is really important. So every day we have to exercise, excuse me, our ability to maintain composure and exercise self-control. Okay, so I've talked a little bit about some different ways you can improve your ability to be disciplined. Okay, um, to be a disciplined trader, and I have a few methods for me that work really well. Okay, uh, I like to take the dog for a walk. That's just something that I do to calm down. And I've introduced a lot of you that have seen me on the live stream. I've introduced my dog on a regular basis, and you know, I, it just allows. It's kind of a meditation for me, if you will. Okay, it's something I enjoy doing. So if I have so much on my mind and there's so many things I want to do, um, so I just have to force myself to, I wouldn't naturally do it. Okay, so the dog comes up to me 3 times a day and she'll pester me to take her for a walk and take 15 minutes in the morning or the afternoon, 15 minutes in the evening, just go for a nice walk and bit of fresh air. It doesn't even matter if it's what the weather's like, if it's raining or whatever. And that to me is a form of discipline. Okay, because I've got a little prompter there helping me. um, the same with exercise. Okay, having a routine of working out every day. Um, very often it's not fun. It's something you do. If you're able to exercise, discipline in other areas of life, you'll find it a little bit easier to do in your day-to-day life as a day trader. Okay. Um, Before I got into trading, I was a recreational poker player. Um, played Omaha, played, stud a couple of times. But I like to play, No Limits Texas Hold'em. And I used to go down to the casino in Dublin City Centre and a couple of times a week. And I play on the cash tables. If there was a tournament, I might enter the tournament, but I play on the cash tables. And More often than not, I would say 9 times out of 10, I would walk away with additional money in my pockets from playing poker. Now, it wasn't big money. I wasn't doing it to try and make a living at it. I found it relaxing. I found it a challenge, because poker is it's a game of strategy. So you put in it's a battle of wits in a lot of cases because you're not competing against the house. You're competing against other players. But more importantly, where I got a lot of the, I think, traits that have helped me with trading is in poker. It's a game of patience and it's a game of discipline because you're calculating the pot odds as you would calculate risk and a reward in trading. But you're calculating your pot odds and you're calculating your chances of success in a poker tournament as well, in a poker game. Of course, you're waiting for the right hand. You're waiting for the right cards to play. So very similar characteristics and to hone for trading. The patience, the discipline, the looking for the strategies. So I found that helped me as a trader. It helped in my day to day life as a trader. So it's really worked really well for me. There's still moments, I've got to be honest, where I'm down, $1,500, $2,000 on the day, and I know I should probably walk away, and I keep trading. There are days where my emotions do get the best of me, and ultimately, on a day like that, I'll look at my trades at the end of the day, and I'll recognise that I should have walked away a lot. Certainly should have walked away a lot sooner. Um, and sometimes I'll impose a little bit of a punishment on myself. Right? You might want to try it. Um, I can't trade for the next day. Or maybe I'll say I can't trade for a week. I did this back in December actually last year. I did this. I had a few red days at the end of November, and it wasn't because the setups were going against me. It wasn't because the trades were going against me. Um, it was because I made bad decisions. I was trading badly, and I looked at my stats a couple of days red in a row. I looked at the statistics. I looked at the trades themselves, where I was getting my entries, where I was holding on to losers, etc. And I imposed a 2 week hiatus on trading for December. I was already up on the year. I've made my money on the year already. So coming into Christmas time, I felt I don't want to be getting to Christmas with a bad mindset. So I need to take some time for myself and reset. So it wasn't so much a punishment. It was kind of rehab for me, if you will. No trading for a week, and then that week extended into a second week. But that the initial plan was I'm not going to trade for this next week, and then the back end of December was profitable for me. It was again, it was kind of retreat, reset, regroup, and go again. That's the mentality that I actually had. Okay, so and you know, sometimes you have to limit yourself to, let's just say you limit yourself to a 500 share position. Okay, so you can't take more than 500 shares. That's your punishment. So for to help you start getting racking up some green days again, you just change your punish yourself in terms of the size that you can take. So for the first 30 minutes, you can only take a maximum of 500 shares, and then you have to turn off your platform. I don't know. I, sometimes you can do that, and it'll just help, just to get refocused, just to push that reset button. Okay. Now, a lot. Next slide. A lot of traders get into the habit of holding losers, and usually what goes hand in hand with that is selling the winners. So you're up 100 bucks and you sell your winner. You're down 100 bucks, but you don't sell your loser. You hold it. So your winners are 100, your losers and your losers are 1,000. Okay, it's very common for new traders, for people learning how to trade, for beginner traders to have a negative profit loss ratio. So when I'm saying to people as they're looking to get in, they ask me, how do I get into it? And I'm saying, think twice and all this kind of stuff. It's risky. Most traders, most beginner traders lose money. This is the reason why. Okay, because you get a few losers that just they get out of hand, right? They end up becoming massive losses, and the winners you just can't keep up with them. So you have end up having a negative equity curve. This is how you end up blowing up accounts, and it does happen. You've not Most beginner traders will blow up at least one account before they actually learn to be disciplined. But on the route to blowing up your account, you end up with this negative equity curve. Your profit loss is just steadily dropping. So, question is, how do we change that pattern? Well, this is really an issue of emotional control and your ability to be disciplined, and to take the loss when you initially said this is my stop loss. Changing stop losses mid-trade to accommodate a losing position is a sure sign that you're not being disciplined, not being a disciplined trader. So if you notice that you're doing that a lot, you really need to think about, you really need to think about improving your ability to trade the plan, right? We set a plan for all of our trades and for all of our strategies, and we have to follow through with it. And sometimes it hurts because you give it, you look at a trade, and if you this last couple few days, as I've said, the last couple of weeks, I've entered a trade and I've been distracted. As a beginner trader, as a new trader, you want to be concentrated. Don't let anything else distract you. Concentrate on what you're doing. I've been distracted with the live stream, for example. I'll be answering questions and trying to converse with people on the chat, and whilst I'm trading, and that's a surefire way of inviting errors. And I've seen it happen. I've been looking at my trades on a daily, and I've seen it happen. So it does happen. Okay, but you've got to follow through with you set the plan. You've got to follow through with it. There's I can be here as your mentor and say, look, you show me your trades, but you're not following through with your stop losses. Ultimately, it's on you to cut those losses, right? Even if I was sitting next to you and looking over your shoulder, you're the one that's got to push the button. You're the one that's got to sell. You're the one that's got to cut the loss. So the most important thing you can do is follow the plan you set when you entered the trade. If you said you were getting into a 20-cent stop and it's down 25 cents, you should be bailing out. There's there's no if or it's just you get out. No ifs and buts. You get out. That's the stop. You get out. And if it reverses right afterwards, hard luck. Accept it. Okay. Um, if it's dropping, if it's tanking, you thought it was going to be a 20-cent loss, but now it's 30, 40, 50 cents. Sometimes it happens quickly. You just got to get out. That's what I do. Just bail out. And sure, there's times where I see a stock that I bailed out of pop back up, like I say, and there's a lot of times where I see they continue to tank, and I made the right decision. I followed the rules that I've set for the trade, and more often than not, if you follow the rules, it will go in your favor. So that's really, really important. But it's look, I know it's hard. I know it's extremely hard for new traders. You just have to get comfortable with experiencing those losses. The whole idea is that with our strategies, with this strategy that I'm trying to teach you, these strategies that I'm trying to teach you here, using a 2-to-1 profit loss ratio, that we can be right only half the time. Our accuracy only has to be 50%, and we'll still be profitable. We'll still make money. So it means half the time you're trading, you're going to be taking losses. You're going to be wrong. Don't. I know I've said a few times that my accuracy is really high. It's over 70%. And I've shown you the statistics. Um, but that's because I've honed. That's taken a lot of practice to get me there. Okay, don't worry about trying to get to the 60, 70% accuracy rates. Just concentrate on staying above 50% accurate. If you're 55, you're doing great. If you're 50, that's good too. You're going to be profitable. So just concentrate on that. Okay, get good at losing. The best traders are really good at losing because everybody loses. They just know how to lose. They just know how to lose in a way that's not going to destroy their ability to bounce back. The losses aren't going to be catastrophic. They're not going to be. What they're going to do is they're going to average in. They're not going to average into a losing position. Averaging down and adding to a losing position and make a bad situation worse. They're just going to take the loss. you know, it's okay. Get knocked down, move on to the next trade. So something that's interesting in the market that I always find the easiest trading is in the morning. Now, the days where I trade aggressively throughout the day, I'm always trying to fight my way out of a losing position. I'm always in a hole and trying to get myself back up to break even. You know, if I'm up and I've hit my goal by 11:30, then there's not really any incentive for me to be super aggressive for the rest of the day. Why? Why do I have to be? I've already in profits. Well, unless it's an amazing setup that's really textbook setup. Um, but otherwise, I'm just going to be grasping at straws and trying to trade anything that's moving. I'm just going to be sitting on my hands waiting for a perfect setup. So, in contrast, if that's how I am on a good day, on a bad day, I'm just going to stick it out in the market. I'm just going to keep fighting it out until either I start to turn profit and go green on the day, or I end up taking a really big loss. What I found is that midday trading is choppier. Um, Trading during the middle of the trading day uh, is it's more difficult, and I think it's because there's a lot of new traders that go in with really big positions, and then they get really, kind of that nervous. I don't want to take another loss, and they mark it in, and they mark it in, and they mark it out, and that creates very choppy markets because when I say they mark it in and they mark it out, they're using market orders, okay, as opposed to limit orders. And that creates very choppy markets in the middle of the day. So I'd like to think that a lot of the professional traders are making the money in the first hour and a half trading, and it's kind of the newer traders that are sticking out midday, and maybe the people that just are very aggressive, and some of them are, yeah, I'm sure one of them making money at midday, but I think the best time to trade is the first hour in the morning, first 90 minutes, and then power hour, or the last hour of the trading day. Um, so I think it's pretty high risk, but I've noticed from my own trading that the days I was trading in between is when I was down on trading and being aggressive. So I sort of think that that could be true, and it's a lot of other traders. It's true, and you know, I just think it's something that I've noticed the market's very choppy midday, and maybe that's the reason. Okay, right. When it comes to trade management, you just have to learn to be okay with being wrong. Trade management in this way is very much combined with risk management. And I've already mentioned this, that changing your risk parameters in the middle of a trade is really bad habit. You just want to walk away. Okay. So when do you walk away? I try to get a solid winner on my first or second trade. If my first and second trade are two losers, then I know immediately I'm off my game because I'm almost always start the day within my first two trades with a winner. That's when I'm at my best. It's my first couple of trades. So if I start the day losing, if I trip out at the starting gates and I just start losing money right away, a lot of times it tells me either my judgment's a little bit off or maybe the market's just not cooperating. I'm not getting the trades that I want. And most likely, the best chance for me is to recover is going to be tomorrow morning. I know that statistically, and just a certain point, it just becomes statistical. These are the numbers. That this is what they say is sometimes hard to believe them, but at this point, I just know it to be true. My best chance of making money will be the next day, right? That's what my stats are telling me. I'm looking at the market. I don't see any good gappers. Nothing's running. I'm just going to come back at it tomorrow. If you're down in the first hour of the day, it's a really good idea just to say, you know what, I'm going to hang up my hat and come back tomorrow. Also, it's really important to size appropriately. So, if you start taking really big size, you have to be prepared to take big losses. So, if you're going to risk $1,000 on a trade, you can take 10,000 shares. That's essentially you saying I'm going to have a 10-cent stock. But you don't want to do that if a stock has a 30-cent spread, right? Or if it's extremely volatile, because 10 cents is going to be unrealistic. So in those cases, you might want to take 2,000 shares with a 50-cent stop. So you have to size based on the risk that you're comfortable with. And that means every time you get in a trade, you're asking yourself, how much am I risking? That has to be a question on your mind. What's your stop and how much you're risking? And then size accordingly. You know, when you're down on a trade, you don't want to be averaging and doubling down, adding more size. You want to be scaling out of the losers. So there are times where if I'm feeling like a trade is not going in my favor, I'll sell half, even if it's just at break even or for maybe a couple of cents profit or a couple of cents loss, just to reduce my exposure, because I already recognize that what I anticipated happening didn't happen. So I better just ease up a little bit. There's nothing wrong with that. That's part of our ability to be fluid and adapt to the market. You might get into something with 3,000 shares thinking it's going to pop immediately. You buy 3,000 shares at $3, it pops up to 302 and then just stalls. Well, maybe I'll sell half on the bid at 2.99 or $3 rather than risk it going down 20 cents to 280 or 289 or whatever it might be. But I should just start easing out a little bit here, because the odds are I'm not the only one that's going to have this mentality that if it doesn't go right, I should bail out. Don't ignore your exit indicators. This is really important. It's easy to do that. It's easy to rationalize why you should be holding a position. But when you're in a position and it's not going in your favor, you don't want to rationalize it. You want to just get out. Okay. So some of the exit indicators that we've reviewed so far, uh, we'll just go over them again here, okay, briefly. A 5 minute candle making a new low, right? If we're in a trade and we want to see this thing trending up, if there's a 5 minute candle that makes a new low, the trend is beginning to change. So 5 minute candle making a new low for me is an exit indicator. If a stock breaks out above a resistance line and then it can't close above that resistance line, that's also an exit indicator. Okay. Let's say a stock has a resistance at $38. This 5 minute candle breaks 38, goes up to 38.10, and then it closes at 37.95. I'm going to get out, even if I still made a new. It still made a new high on the 5 minute, and it didn't pierce the low of the previous 5 minute. I'm going to get out because it was unable to close above that resistance line, which I thought was a very critical level of resistance. Right? Why wait for it to go further down? The fact that it couldn't close above that level is a problem. The thing is with breakouts, when we're trading breakouts, the whole point of trading the breakout is if it pulls back, it's got to hold that resistance as support. Because if it breaks the resistance and then pulls back and fails and goes back below it, that's what's known as a fake out. It's not actually holding that level. So if it breaks the resistance, very often it breaks resistance on volume and goes up. If it pulls back and goes below that resistance, then is the volume there? Is the volume there? Now, let's say we get breakout above 38. Go up to 38.03, where we thought there was going to be 100,000 shares of volume. It was only 5,000 shares. Like I say, it's no volume. We've got to get out, right? We want to follow the volume around the market. So if there's no volume in that breakout, we need to bail. That's an exit indicator. And now an extension bar forces us to exit. Hang on a minute. An extension bar is a big candle. It's a candle that spikes up sometimes the 25, 30 cents, they can be as big as $1. Or even $5 in some cases. Huge spikes. We have to start selling into a spike, right? And anytime something spikes, we have to start booking profits, because as soon as they spike up quickly, they can come down just as fast. So when we get that type of move where all of a sudden our stop is like 50 cents away because of a spike, uh, we've got to start locking up a little bit, taking some profit. So that's a good question. If you start with a risk of say $50 a trade, your question is, would it be better to focus on stocks with a tight spread? On the one hand, I would say yes, because stocks have a big spread, can be more likely to chop you out, and then you end up getting a lot of slippage. So, say you took say you took 500 shares of a stock that has an 8-cent spread. Well, when it drops, it could very quickly open to 20-cent spread, and then you get slippage on that, and you could be down 30 cents when you really only thought you were risking 10. So I think focusing on tighter spreads is important when you get this comes back to one of the previous lessons on stock selection. So the spread is an important part when we're looking at stock selection. Okay. So what we really want to do is focus on stocks that have a lot of volume, um, because very often the spreads on high volume stocks are a lot tighter. Okay. Okay. So when we're looking at extension bars, if it gets too extended, it can pull back really quickly. Think in the in previously we were talking about the elastic band analogy. So if we get a decent profit level up, we're up 50 cents. We want to lock in at least half of our profits there, ideally, or a third of our profits, um, ready for that elastic band to snap back. So just be always be mindful of those that elastic band analogy when you're looking at stocks that are getting extended. Okay, that's that's when we're looking at extension bars, we're looking at stocks that have become extended. Okay, right. Okay, I just want to show this. Just want to show this example. Right. Here's an extension bar example. This right here uh, is this is where we see the candle breakout 72. The breakout was at 72, and okay, so it breaks out at 72, and we get a pop up to here 75, uh, 75.32. Okay, a big move like that, we have to sell uh, into it, because it's usually going to fade. It's usually going to sell off a little after a big move like that. If we manage to get a big move, we take profits up here. We've got to take some profits, because it may well pull back and we get a bull flag forming. If we get a bull flag forming, that's great. And then we get the breakout of that pattern for another push. We can buy into that, but we need to be taking profits before it pulls back. Okay, so after a big move, when we're in a stock that's ripping up, I always start to lock in a little bit of profit on the way. I don't want to sell everything. I want to keep a little bit because it might keep running. But I'm reducing my risk, booking some profit, and then once we start to see the tide turning, a shift in momentum, I'll get the rest out. I'll close the rest of the position out. Okay, hope that makes sense. Okay, so it's very important that we understand stocks that are trending. So sometimes someone will show me a stock for a setup, and I just look at the trend and I can see a bigger picture of the stock. I realized that they were so zoomed in on maybe 1 minute chart that they weren't able to see the larger trend. So we always want to take a step back and look at the bigger trend. Zoom out a little bit and look at the big trend. If you look at the 5 minutes, this is why I trade the 1 minute chart. I get my setups on the 1 minute chart. I take profits and stops on the 1 minute chart in the main, but I'm looking for setups to be underpinned on the 5 minute chart. And if you're looking at the 5 minute chart, you can zoom out to the look at the 15 minute chart if you find it helpful. I'm always wanting to get in stocks that are strong and trending up. So this is where using that 5 minute candle, the stocks that are making new highs and not making new lows. That for me is a big indicator of a strong trend, right? Looking at the moving averages, they're curving up. Okay, looking that you've got the 9 EMA above the 20 EMA. Okay, and 20 above the 200. That the moving averages aren't braided together. If they're all wrapped together, then we're sort of sideways, and that tells me that you need to be looking at the bigger picture, and that the bigger picture that the stock is not really in a strong upward or downward trend, that we're more likely in a box, um, maybe with a strong area of resistance or a strong area of support, and we're just trading inside a range. Okay, so generally, as soon as something starts making a new low on the 5 minute, I'm going to get out. The only exception will be that if we're in a stock that we have a really good average on and it rips up and it starts to pull back on light volume. And I think it's the beginning of a formation of maybe a bull flag. If that's the case, um, I'll have taken some profit, but I might just hold uh, the the remaining position. I might just hold that through the bull flag and then look to add as it breaks and resolves to the upside. But that's going to be something that I would only do if I already had a big cushion on the name um, because I was up a lot. It's not something I would do in most cases. Massive indicator. Okay. Where did the volume go? I've been saying that the last few days. I've been saying that about the market in general. But I mean, let's talk about trades. Let's not look at the macro verse. Let's talk about individual trades. So anytime we're in a stock and we see volume declining, that's going to be an exit signal, right? If we got in and there was a ton of volume and all of a sudden the volume is just completely dried up, I'm going to bail out. The strong volume confirms the breakout. When we lose that volume, uh, we don't still want to be holding that trade. So it's always good to keep an eye on the volume. Here we go. A light volume pullback is okay, but this is an example of a stock that surged up, and we see the volume spikes here. It surged up to this point, and then it starts to pull back. And when we're pulling back, we're on lighter volume. Okay, you can see how light the volume is on the pullback, and that's okay because that's consolidation. That's part of a stock making a big step up. It's consolidating sideways and getting ready for the next move. So the only time light volume is okay is when it's in consolidation. Okay, when it's getting lighter, and that's fine. That's fine. But even in this consolidation, I wouldn't want to see it go down to like say 1,000 shares a minute. I would I want to I would I would want to see that it's at least still actively being traded. Okay, so this type of stock here, I had a really big volume on the breakout. So you see the big volume spike down the bottom, pops right the way up, and then nothing. Even though it's still going up, the volume is very light. So what actually happened here is we've got big volume on the breakout. Uh, there was it, it was a news trade that had come out in the middle of the day. Big volume shoots up, and then it's going sideways. Now, when you look at this chart pattern, you could see it. You could probably see it looks like an ascending wedge. We've got kind of a flat top forming right around the $5 mark. Okay, and it's sort of holding up there. So should we buy this pullback? And the thing is, when we look down, when we look down here, we see this massive volume spike, and then this level of volume. It just isn't sustained. The volume died out quite a bit, started to come back a little bit, and then it just really went down to like nothing. So when it's nothing down here, and if it, because there's no volume at all. What are the odds that this thing is going to have a big breakout at the end of the day? Unless the volume comes back into it, the odds are very slim. So scaling out of losers, we talked about this a little bit. If I'm in a breakout trade, and I'm in full size, or I've doubled up. Say I bought 2,000 shares, and then I doubled up to 4,000, and it looks like it's not working out as planned. I may just sell half to reduce my exposure, even if that half is selling off. Okay, I only want to be in a full position if I have total confidence. So as soon as my confidence is starting to drop on a position, I need to start lightening up and reducing my risk. That way, if I've decided to have 10,000 share position, and that's going to be me having total confidence. If it starts to show a little bit of weakness, I'm going to try and sell 5,000 shares for at least for break even. Okay, immediately reduce um, my max risk in the trade. Right, the max loss on 1,000 uh, 10,000 share position is a lot worse than a 5,000 or a 3,000 share position. So when I'm scaling out, if it's this type of scaling out of a loser, usually I'm just going to get out on the bid because I want to immediately lighten up and reduce my risk. If I'm in the driver's seat and I'm scaling out of a winner, I'm going to sell on the offer. I'm going to sell on the ask. But when I'm in a losing position, uh, the risk, especially if I have size, I mean, if I see someone sitting on the bid in the level two with 5,000 shares, I might just go and hit it because look, someone's sitting there. I can get it right now because if I don't, and a few other people begin to recognise that this weakness is happening, this thing could just drop 10 cents and I'll be down, 500 bucks. Those 5,000 shares that I should have just sold. Um, so trying to sell on the offer when it's weak, you might not get filled, right? If it's weak, it's usually because there aren't buyers. So trying to put your shares on the offer when there aren't buyers isn't going to do anything. No one's going to be there to buy. So entry indicators. Just the way we have our exit indicators, we also have entry indicators. And these are going to be these are going to be strategy specific, right? We've developed specific entry indicators for each strategy that we've created. So we covered strategies in a previous lesson, and we covered the entry indicators in that as well. So whether it's the gap and go, the momentum strategy, or the reversal strategy, we know what our entry indicators are. So just as a summary, if we can establish 2-to-1 profit loss ratio, that's going to be a trade that we should consider taking. If we have our strategy, if we have our pattern, and we can get that profit loss ratio with a tight stop, that's a trade worth taking. Now, I like to try to lean into positions when I feel really good. I'll take half size. So if let's say my max size is 10,000 shares, so I might take half size leading up to the breakout, and then double double up on the breakout with confirmation. I really like doing that because when I go in, when I go in, say my max position is 10,000 shares. If I just pump in with 10,000 right away, I have no wiggle room. I can't add more if it feels good. I can't I'm going to immediately have to bail if it doesn't look right. So I don't like to put myself up against the wall that quickly in the trade. So I like to lean into them if they're going well. I'll double up. So maybe I'll start with 3,000 shares, or if it looks good, I'll add another 3,000 shares. And if it's about to go, if it looks awesome, or I'm already up a little bit, I've got a cushion, and I want to add a little more to catch this final breakout, I might add another 3,000. So slowly adding up is going to help me manage my risk better. That way, I'm never worried about going in with the full position and immediately having to get stopped out with a massive loss. So, in other words, the only time I have a full position is when I'm kind of legging in and I've already developed a little bit of a level of confidence and a kind of understanding of how this stock trades. So I've already got a little relationship with the stock. I know how it's trading. I know what the spreads look like. Um, I can tell with what the level twos are like. So if I'm adding up, it's because I already know that this all checks out and it all looks good. So just want to next slide here, okay? Want to talk about scaling into winners. Just actually talking a little bit about that. But how do we scale into our winners? Okay, so on a winning trade, the let's say I'm entering half size. I mean, some of the biggest winners. Let me just preface this. Some of the biggest winners that I've ever had. Granted, not just recent, not my biggest winner. That was I got quite lucky with there. But if I go back to when I was trading DWAC last October, which up until last month was my was my biggest winning trade. Um, I've had a lot of success um, by scaling in. So if I'm in a trade, like I said, and I take half size and I jump in because I'm confident the stock's about to break out, but the breakout starts to happen, so add more and I add to a winning position and I add to a winning trade. Okay. Occasionally I'll be totally right and the stock will just run and I'll have my full confidence, say 10,000 share position. Okay. Other times it'll start to show weakness and I'll start scaling out, but usually I'll start adding. So let's say I start adding at $3 within it. So the intention is to double up at 310. So if I double up at 310, now I've got full size position, but my average is 305. So I've already got a little bit of a cushion off my average. Okay. So when I'm adding that, for me, it really puts me in the driver's seat. Potentially, I could say, well, I'm going to take 5,000 shares at 305. I'm going to take another 5,000 at 320. That's going to give me 10,000 shares at a cost average of $3.10, $3.10, $3.12. And I'm going to set my stop at 310. Okay, so in that scenario, I've got 10,000 shares with a break even stop. Now, I was already up 20 cents on the 500, so I, I was already up $1,000. What I'm basically saying is I'm willing to give back the money that I'm already up for the potential of holding a 10,000 share position and getting a run to, let's say, 340 or 350, right? And then let's say you get a run to 340. You're up 30 cents now on a 10,000 shares on what was a break even stop. Okay. So that's the type of trade where when the markets are going, when the trade is going really well, the markets are really hot. When we're on a hot streak, I'm going to add into my winners and I'm going to get a few of those really big trades. You know, I get a few of those each week, and they're just going to be the result of seeing something that looked good and sizing into it. Um, so as it went up, we're scaling into the winner, right? So that's how I make my winning trades bigger. And a lot of people say, well, if you're in a loser, you can average down. That would be called scaling into a loser, right? What's that going to do? Well, it's going to make your losers really big. So you don't want to scale into losers. You want to scale into strong stocks, scale into winners. Okay. Scaling into the breakouts. So when we're approaching a critical breakout level, I like to add size right at the apex point. I like to double up. I want to see that buying volume is coming in, and when it's coming in, I like to add shares there, because if I just waited until, say, the breakout point on that stock was 320, so instead of having a good average, I just decided I'm going to wait till 320. Sometimes at 318, all of a sudden someone's going to come in with like 20,000 share order, and it's going to rip up to 330, and you never got a chance to get filled. You didn't even stand a chance, right? So you were totally right. You had the right idea, and you don't get filled because you know that's what it is. You didn't get in early enough. You didn't react early enough. You missed your chance. You missed the window, and that's another reason I like to take half size, because then if I miss the window, at least I'm still holding half size. At least I still get paid for being right, even though it's not going to be maybe the big winner I wanted with a full size position. At least I get a winner. So again, we want to follow the volume. If the volume starts drying up, we need to accept that this is a failed breakout and move on to the next trade. We can't force the market. If the stock doesn't want to break out, it doesn't want to break out. There's nothing wrong. There's nothing we can do about that. But if it doesn't look like we're losing volume, we've got to scale out. Especially if you've doubled up and you got really heavy on the trade, you need to start lighting up right away. Unwinding that position, moving out of it, reducing your risk. because when we have very light volume, one big seller comes in and that can really drop a stock. It can drop it, what, 15, 20, 30 cents in a very short space of time, in a matter of seconds. And you never want to be holding full position into that type of scenario because you're very vulnerable. Now, anytime I'm in a winning position, anytime I'm in a winning position, I want to start scaling out of those winners. So my exit indicator for a loser is really the same as a winner, right? Extension bar, 5-minute candle volume drying up. Those are some of the exit indicators I'm going to look to start scaling out of winners. But if I also like to scale out when I simply have profit. So if I have a 20-cent stop and I'm up 20 cents, I'm usually going to start booking a little bit of profit right around the kind of 1-to-1 ratio. You know, if we're looking at where my first take profit point is at, you know, a similar size in the positive as what I'd set my stop loss. So when you're hitting the profit of $100 and you're risking $100, that's usually a good time to start taking a little bit off the table. Give yourself a little payday. And having the right idea. Once I've scaled out a little bit, I can almost always adjust my stop to break even. So I was risking $100 to get in the trade. When I'm up 100, I'm going to sell half. So I'm going to say I'm going to lock in $50, and I put my stop at break even. Even if I get stopped out at break even, I still locked up a $50 winner. Still locked up a bit of profit, and it was worth a try. If it ends up continuing, then I'll be able to add a little bit more into that winner and maybe end up getting $125. But I did it in a way where very quickly, very early on in the trade, I was able to get myself in the driver's seat. I was able to take a little bit of profit and break even. You know, just because we have unrealized profit doesn't mean it's a winner. Not until we've sold some of those shares. How many times we've seen a big winner go right back to break even? You know, until you've locked up a little bit of profit, it's not officially a winner. So I always like to lock up a little bit, even if it's selling, a quarter position. Say I'm in 1,000 shares and I sell 250. Lock up a little bit of profit. Put my stop break even. Now I'm in the driver's seat. Now I have confidence, right? Now I'm very confident that I'll be able to lock this up as a winning trade, even if it's only a small winner. It should be a winner. And for me, that's a big confidence booster. Trying to have a high percentage of success, lots of small wins, lots of small losses, but always setting myself up for the potential for a big winner. That's what's really important is that we're set up for big win potential, even if we don't get it. Now, trailing stops. This is another method of keeping yourself in winning trades as long as possible. If we haven't seen a new low on the 5-minute candle, we shouldn't be selling our final 100 or 200 shares. That final core position, we want to hold until we get stopped out. Practice holding until you're stopped out. It's a really good discipline. Okay. If you haven't been stopped out, there hasn't been an exit indicator. You shouldn't be holding 100 shares. Even if it's only 100, you should still be holding a little piece, right? That gets you it gets you just trained to hold stocks until you get exit indicators, and not be one that sells too early, right? We want to hold our winners, not our losers. We want to sell our losers quickly, but scale out of the winners and hold them as long as we can. So this stock here, look at this example. A stock using the 5-minute trailing stop loss. Okay, this is a stock that it stir steps up using 5-minute trailing stop. Okay, We get in this 18, $19, and it runs up to $30. That was the big percentage of the biggest percentage winner. Okay, uh, I mean that's a lovely win, but you're constantly scaling out along the way. So you keep 50 shares, um, 50 shares, and you're up 10 points. It's an amazing win. I think this was an IPO stock, but if you sell the whole thing plus plus 10 cents when you're 10 cents up, um, then you're capping your profit potential. And we don't want to cap our profit potential. We want to cap our losses, not our winners. So we cap the losses and we leave the profit potential open by keeping a little piece for that big run. Because you never know when you're going to get a big run like we got here. Okay. In a couple of weeks ago, I ran with Inspirato, and that went up 750% on the day before it started to pull back. Now, I got in there, it was extended, it was 250% up on the day when I first got in, when I took my first trade on it. Now, normally, most stocks, if they're 250% up on the day, they're maxed out. They're so far extended that they're ready to come out. So when I got in there, I was able to just do this stop mentality, add to the position, move my stop further up, take profit, move my stop, add to the position, move my stop, take profit, and keep doing that and stir step up, very much like this position. So personally, personally, I don't use live trailing stop orders. Um, I just put in a manual trailing stop. For me, I'm pretty much one trade at a time. So I just put in that one trade and I focus on it 100%. Now, what I might do if I'm down to like 100 shares, I might go ahead and just put in a manual stop, uh, a live stop at the low of the last 5 minutes. Okay. And then just keep adjusting that every 5 minutes or so. But an actual trailing stop, um, it will sell. It will sell me if it goes up 50 cents and then pulls back 50 cents. I don't normally use those types of stops. Uh, in terms of figuring out how many shares you want to use, I mean, there's a couple of things you could do. This becomes well, it's personal preference, but it comes like second nature. It's like muscle memory that you learn. You end up learning the maths related to trading stocks. Okay. What you can do is you simply make a little spreadsheet that you put on your desk, and you've got 10 stock, and you only want to risk $100, and you take 1,000 shares, right? If you've got a 20 stock, you're going to risk 500 shares. You're going to put in 500 shares so you can create a spreadsheet, and try to stick with stop losses that are maybe easy math increments, right? So 10 cents, 20 cents, 30 cents. If your stop loss is 18 cents away, just call it 20 cents. So it's like a 20-cent stop. I'm just going to use 500 shares. I think that will help you a lot to start off with. You'll just have that there by the side of you as you're trading. You'll just have that table you'll be able to look at whenever you're trading. If you see something that looks good and you can get a 10-cent stop and you can take 1,000 shares, then you know that that'll work. You'll just have that right there at your desk, and you know you can look at it whenever you want. You know, stick it on your wall, stick it on your desk, um, you know, wherever you need. So it's a quick reference cheat sheet, if you will. Okay, right. I think that's pretty much it now. We're pretty much done for the day. So any questions on that? If you've got any questions, here's my email address. Uh, just ping me an email address. As usual, the tools that I use for charting, TradingView's great. All my scanners, Benzinga, you can use a spreadsheet. You can use one of the other trading journals that are available in the market. I use TradingView. I recommend it. It's you can get a free account with it's a freemium offer there, so you can get the free option. It's limited to kind of 100 trades, but it's good for beginners to start tracking. And you know the next one up's only like $30 a month, so that's not a bad not a bad option either. So yeah, the next chapter we're going to go over level two, and I'm going to cover off what to look for on level two, and the data, and we're going to cover hotkeys as well, hot buttons or hotkeys. And join me on the next lesson. I hope you got a lot out of this lesson, and it's helping you feeling more like a confident trader already. We're coming up to the back end of the course, so we've only got 4 more lessons after this. So join me on the next lesson for level two and hotkeys. Thanks a lot for joining me on this one.